Let's talk the new travel levy. Cruise ship travellers are likely to be charged a higher rate, possibly nearly $3 a person more than others under a newly levy imposed from January on all travellers arriving and leaving New Zealand. A public consultation document on the border clearance levy confirmed in the government's May budget recommends a higher rate for cruise ship travellers, reflecting the extra costs incurred by the Ministry for Primary Industries and Customs New Zealand in processing cruise ships stopping at multiple ports. The original levy cost was estimated at $16 for arriving passengers and $6 for those departing. The consultation document suggests a range of $15.20 to $15.90 for arriving, $19 to $19.70 for arriving cruise ship travellers, and $2.60 to $3.10 for departing travellers. The new tax comes on top of existing airport charges. By 2017-18, the levy is expected to fully fund the $103 million a year it costs to protect New Zealand from pests, diseases and contraband. Treasury documents released today show it's likely to return Crown savings of $25.9 million in 2015-16, $78 million in 16-17 and $104 million by 17-18. Despite savings from the levy, the Treasury didn't support a budget decision to reinvest an additional $4 million in operating funding in the 2015-16 financial year and a one-off capital injection of $2 million plus $4.6 million in extra operating funding from 2016-17 onward to increase staff numbers, X-rays and dog inspections at the border. There has been increased demand for MPI and customs services at the border, with air passenger volumes having grown 19% and cruise ship arrivals up around 80% in the past 5 years. Air passenger growth is expected to continue at near 3.5% annually. The consultation document says the risk profile of passengers and crew is also changing, with more arrivals from emerging economies that carry higher risk. Social and economic costs of not meeting these risks can be high. For example, the current Queensland fruit fly response is expected to cost around $17 million, while the estimated economic cost of a foot and mouth disease outbreak as occurred in the UK in 2001 would be up to $16 billion. It's expected that airlines and cruise ship operators will collect the levy on behalf of government, and the document recommends all those buying tickets before January 1, even if travelling later, be exempted. No exemptions are recommended, with all travellers, including crew, to be charged. The document said Customs and MPI may also consider alternative charging arrangements in future to recover the costs when higher levels of service are required, such as servicing ad hoc arrivals or remote locations, establishment costs for new and restart airports, and VIP processing. 3 public meetings are being held in Auckland, Wellington and Christchurch over the next 2 weeks on the levy, with input sought on how it's collected, if rates should differ from transport type, and possible exemptions. Submissions close on July 28 and the government will make final decisions in October-November. Let's talk investment. Early-stage investing is enjoying a surge in popularity in New Zealand. The record levels of angel investment, growing venture capitalist numbers and emergence of equity crowdfunders all bode well for entrepreneurs trying to bolster their young companies. But those involved at the coalface warn there are great risks involved and a high likelihood all investment will be lost. The New Zealand Venture Investment Fund warns at least 4 in 10 early-stage companies fail and points to its own experience as a lesson. The NZVIF has released research from its 12 years in action, which shows for every $1 of initial investment, 2 to 4 times more is needed for follow-on investment. And while a fifth of exits have earned back the level of investment or better, 40% of the portfolio has been written off or is valued at less than the amount invested. NZVIF Investment Director Chris Twiss told NBR that significant amounts of vetting occur, and for the 187 companies the fund is invested in, another 1,000 to 1,500 have been looked at and passed over. Mr. Twist says, but once the decision has been made to invest in companies like these, you must be in for the long haul, as they may need more money. Be prepared for the company to not last the distance. For internationally oriented seed and startup companies, the risk profile is extreme and they are highly illiquid assets. It's almost impossible to sell the investment in the first few years of operating. It's an extreme risk, and we can see that coming through in our data. The same goes for equity crowdfunding companies, he and Shareholders Association founder Bruce Shepherd say. For more on this, get today's print copy of NBR.
I'm John Stewart. It's Friday the 10th. The Treasury has warned Cabinet of some problems with Nick Smith's housing plan. To talk about that, I'm joined by reporter Chris Hutching in Christchurch. So what actually was the Treasury warning Cabinet about here, Chris?
Well, it was just about everything that went wrong in the end.
Right.
So this person who wrote it perhaps had a little bit of prescience and seeing these problems ahead. You might recall how Nick Smith dragged some journalists and interested people around Auckland and showed them a whole bunch of blocks of land.
I do.
And said, look, these are going to be, great to redevelop. And as it turned out, there was a whole lot of problems. Some of them were owned by other Crown agencies, some of them were reserves, some of them had to be offered back to original owners under the Public Works Act if they were to be used for certain things by government. So all of these things came to pass, and then, of course, there was an iwi that was in that group of people who had rights of first refusal as well. So these things were all tabulated in this Treasury report, and they warned them against doing it at the moment. They said, look, just hang on, wait till you've got all your costings sorted out. And in the end, Nick Smith had tried to get a contingency of $120 million set aside for this. Cabinet must have taken some note of this Treasury paper because they only approved $52 million in the end. Now, there's a little bit of a follow-up to the story that we've got online, which I have put together, and we'll put it up a little bit later on, and that points out how there was a lot of money allocated to Christchurch for similar sorts of projects. There was about 73 million of it. Now, it turns out that of that 73 million odd, only around 13 of it was spent. So there was 16 million underspent in these Christchurch projects, and the Treasury paper speculates on how this money is now being transferred to the Auckland developments. So it all gets a little bit confusing, really. We have these
muddy, to say the least, yeah.
And in the case of Christchurch, they're not being spent, and in the case of Auckland, they haven't given them as much because they've learned from the Christchurch experience. It all seems rather a mess, John.
It certainly does sound it. And I think the number of hectares which Nick Smith was talking about for housing has gone down with the torchlight of reality shone on it, from 500 hectares to 100. Am I right in that?
Yes, I think that's about it, given all the complications. You see, a lot of these bits of land were owned by just about every agency you can think of. Yeah. Some of them were the likes of the electricity state sector companies and Ministry of Education, these sorts of things, NZTA. So, just how suitable they were anyway is a huge matter of conjecture. But it's kind of pretty disappointing for Aucklanders, that is for Aucklanders who are trying to get into the property market anyway, because, once again, it sort of seems like 3 or 4 steps forward and 4 back,
Yeah, indeed.
So I'm not quite sure, where Mr. Dr. Smith's policies in relation to Auckland housing are going to go from here.
Watch this space. Thanks very much for that, Chris.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio, Friday the 10th of July. I'm Andrew Patterson, and with me Jason Walls for our weekly macroeconomic roundup. Jason, a good place to start this week. China, we saw quite a dramatic plummeting in share prices, and it has been compared to Wall Street in 1929.
Yeah, absolutely has, and I think that word dramatically is so perfect here because it's been absolutely dramatic. You've seen that China's stock market, basically non-existent from mainstream media headlines, has basically just swamped everything within the last week, although this has been going on for about a month now, and it's just crazy when it gets to this crisis point that everything just erupts. But yeah, you're right, it's been compared to the Wall Street crash of 1929 because there's just so much going on. I mean, we were just talking off air a second ago about when the stock market crash happened in 1929. It was the shoeshine boys giving advice to the traders, and that's when you know that it's hit the fan, essentially. And in China, we've seen all sorts of people trading. We've seen people out in the provinces, like on a banana stand, just trading at the same time. So it's got the same sort of undertones. But it's the word bubble's been thrown around a lot because this last year, within China, the stock market has just been huge. It's just absolutely
almost like a casino, really.
It's almost comical to look at the charts of, when on the cartoons when they're just showing business productivity or something like that, and then it has the big downward spike. It's been like that in China, and it's just been going up and up and up and up and up, and then it got to this level, and it just fell off a cliff, and it was insane. We saw that all gains from the Hang Seng have been lost from this year, all of them. So it just been keep building and then all the way back down. So it's a crazy thing. And this comes off the back of the massive amount of stimulus that the Chinese government has injected into the economy. We talked about it last week, just as on the cusp of when this was happening, that the Chinese government had reduced the reserve requirement ratio. They had cut their interest rates at the same time, which is the first time that they'd cut both of these at the same time since the financial crisis of 2008. And since then, we've just seen this story just rocket, and it's just been crazy.
What's perhaps made it more dramatic is that in recent days, the attempts by the Chinese government to avert the situation has only ended up pouring more fuel on it.
Yeah, and that's another parallel to the stock crash of 1929, because the government in the US did the same thing, and it had no avail. And in China, you saw the government been buying a whole bunch of blue chip stocks, and it hasn't really been doing anything to stop the plummet. In fact, I read somewhere, I think it was 40% of Chinese companies suspended trading yesterday. 40%. It's insane. And although New Zealand really doesn't have a huge connection over there in terms of a lot of us owning stocks, I think there's about 2% of New Zealand or foreigners in the Chinese market. So the amount of New Zealanders is quite slim. This will have quite a flow-on effect because of consumer sentiment. And it was an interesting piece. I got to talk to somebody from ANZ the other day about how this is going to affect New Zealand. And essentially what happens when you see a stock market plummet like this is consumer sentiment takes a real hit. So people start to get this glum look of the economy and say, hang on, I'm not going to spend as much because this is down. And this sticks for a little bit. And this is quite a concern for New Zealand because obviously we export a lot of dairy and a lot of commodities like that into China. And if they're looking to slow down things like buying for dairy, that's going to hit us in the short term. However, in the long term, it's a little harder to tell because there's still so much demand out of China for New Zealand products.
All right, and perhaps just as an interesting, ironical twist, we did see this technical issue on the New York Stock Exchange as well overnight that saw trading suspended for a couple of hours. Interesting that you have Greece, China, and the New York Stock Exchange kind of all having problems in the same week. Yeah. Might suggest that darker clouds loom in the future. Let's turn our attention to Europe now. Of course, a lot has happened this week. We got the clearly decisive no vote out of the Greek referendum, and now we wait for this new proposal that Greece has to present by this weekend to the Eurozone leaders, and this is basically its last roll of the dice. Yeah,
this is basically the final offer. I mean, this has been building for a long time. We've seen time after time after time the proposals by the Greeks to the creditors have just been not good enough. And then we had, of course, the week before where they said, hang on a second, we're going to need more time because we need to ask our people if they're okay with these reform measures that they're outlining. And, of course, as you said, it was quite an overwhelming no. 61% of the population came out and of support of the government. Since then, there's been a few things that have happened. We had the Greek finance minister, who's the shadiest character in world economics right now, stood down because he thought that the negotiations would go better without him. Probably the smartest thing he's done this whole time, actually. So it's good to see that he's kind of left doing something good. But yeah, the fact that they voted no really is not very optimistic for anybody in Europe, because if they weren't accepting the austerity measures before, there is even less of a chance they're going to do it now because they have the mandate of the people who said no. And the reforms that the creditors from the ECB and the European Commission, and not the IMF anymore because they've defaulted on that loan, are likely to be a lot harsher. And they'll need to cut taxes. They'll need to increase taxes. They'll need to cut pensions and things like that. And they're obviously, from what we've seen, that's something that they're not going to do. In fact, I saw a funny little anecdote the other day that the Greeks are going to just wheel a big wooden horse outside the gates of Germany and just say, here's all the money, and inside's going to be a whole lot of bankers. But, yeah.
I heard a very strongly worded statement in the European Parliament which suggests that Greece isn't likely to get a lot of sympathy from those when it does present its proposal this weekend. The calls made in the speech were the fact that the Greeks have done very little to reform, and so a lot of this problem clearly has been of their own making.
Yep, and the next step is, number one, they're not going to be able to pay back anybody without more cash injection. They can't get more cash injections without more stimulus and without more bailout funds, and they can't get the bailout funds without austerity measures. And they've said no more austerity measures. So putting two and two together, it's not a very good outcome for the Greeks. And the next thing that we're going to be talking about is the Grexit, because that is likely. There's people saying in different corners, yes, they're going to be kicked out. No, they're not. But it's all up in the air in this stage.
And what is interesting is that it does not seem to be a lot of contingency planning. This is being dealt with on a play-by-play basis. And it's not as though anybody's talking about the fact that they're already printing the drachmas ready to go for Monday. So it'll be interesting to see how things evolve from here. Let's turn our attention to Australia now, which has announced it's keeping its interest rate on hold. It did that earlier this week. What are the implications, particularly for the RBNZ?
Well, no, this isn't a surprise to anybody, first of all. Practically every analyst was saying it's going to stay on hold because we've had a couple of cuts earlier this year, I think one in February and then one a couple of months ago. And so it wasn't a surprise to anybody that they kept it on hold. However, they want a lower currency. And Mr. Stevens himself said it's unsustainable at the level that it is right now. We need to bring it down. He's not doing that through interest rate cuts, so it sort of leads you to wonder how they're going to get it down. And I'm thinking probably it makes sense that they're waiting for the interest rate hikes in the US. We've talked about that a number of times, how the imminent hikes are coming at the end of, it's September. It's being outlined as whether it'll actually happen then or later or even next year, who knows. But when the Reserve Bank of America, the Federal Reserve in America, up their rates, it's going to bring the currency in Australia down. And so that's going to be favorable for Mr. Stevens. At the same time, it's quite interesting to look at New Zealand and Australia because they've almost not switched positions, but they've almost switched bias, because we saw even as close as 6 months ago, the Reserve Bank of New Zealand had on hold bias, and we were happy at 3.5%. And Australia was looking to get down. See, they made those cuts in February, and then after that they had that easing bias. Now we've essentially seen a shift where Australia's sticking at 2, and New Zealand we just cut from 3.5 to 3.25, and the market is pricing in 100% cut on the 23rd of July. So we're going to see it go down to 3, and then after there, it's kind of crystal ball territory, but most analysts are picking a couple more, and we're going to be below 3 easily by the end of the year.
All right. Thanks for the update. Our macroeconomic weekly review with Jason Walls on NBR Radio.
NBR Radio. Free to air online with business news you can use.
To guest nights, New Zealand guest nights rose in May at their fastest pace in 2 years, fuelled by a rebound in both domestic and international travellers and a lift in South Island and hotel park stays. According to Stats New Zealand, seasonally adjusted guest nights advanced 2.6% in May from April, the fastest pace since May 2013's 8.4% gain, and snapping the previous month's 0.6% decline. Stays in the holiday parks jumped 5.2%, while backpacker nights climbed 3.4%, motels advanced 2.2%, and hotel stays rose 1.3%. Domestic guests increased 2.6% in the month from a drop of 0.3% the previous month, while international guests rose 3% from the previous month's 0.1% fall. Guest nights in the North Island rose for the 4th consecutive month, up 2.4%, while South Island stays increased 3.3%, snapping April's 0.6% decline. The agency said on an annual basis, national guest nights in May climbed 5.5% compared to the same month a year earlier. That was due to increased South Island guest nights, which were up 8.5% in May from a year earlier, and a 3.9% gain in North Island guest nights. International stays rose 12%, the biggest gain since May 2013, and domestic guest nights increased at a more modest 2.3%. Business Indicators Neil Kelly said, as in the previous 3 months, most of the rise for May was from international guest nights. 2/3 of the increase in international guest nights occurred on the South Island. Total capacity in short-term accommodation rose 0.1% in May compared to the same month the previous year, snapping 8 months of declines. Occupancy rate increased to 34.3% from 32.8% in the same month a year earlier. In market results, tourism in Queenstown and Rotorua has delivered healthy returns for gondola and luge operator Skyline Enterprises. The company, whose shares are traded on the unlisted market, says its pre-tax profit grew 20% to $63.3 million for the year to March. Trading profits contributed about half of the increase, the company said, with the remainder coming from property valuation gains. Directors recommended a dividend of 42 cents a share, or $14.3 million, up from 37 cents last year. The company said with future demand to fund planned new investments and reinvestments in our established businesses, directors have again adopted a prudent approach in terms of the dividend payment. Skyline shares last traded at $13, valuing its equity at $443 million. The company said patronage had risen at its flagship Queenstown gondola property, and it planned to invest in more capacity to take advantage of long-term growth. In Rotorua, where Skyline operates another gondola and luge attraction, the company said an upgraded restaurant, zipline and mountain biking had improved its product. Chairman Mark Quickfall said this and other initiatives have seen an improvement on past results. The famous Crankworks mountain bike festival hosted at Skyline Rotorua in March 2015 was an outstanding success and provided valuable international exposure for Rotorua and Skyline. The company is yet to publish a full annual report, but said it was continuing to look for more luge opportunities overseas to add to its existing ventures in Singapore, Canada and South Korea. Skyline's Christchurch casino had yet to recover from the earthquakes, but its position was improving as the city began to rebuild. The company awaits a court ruling on a legal dispute between its subsidiary, the Helicopter Line, and Airworks subsidiary Heli Holdings over helicopter maintenance and leases. The case involves a $9 million claim by Heli Holdings for alleged wrongful cancellation of a helicopter lease contract and a counterclaim by the Helicopter Line of $5 million for deficient maintenance.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebret.com. NBR Radio.
In budget papers released this week, the Treasury advises the government to consider a shutdown of KiwiRail's freight network. In his Editor's Insight today, Neville Gibson has been looking at the future of KiwiRail. Neville, this Treasury advice to close the railways is radical. How bad is KiwiRail's situation?
Well, the Treasury is charged with looking after the taxpayers' money, and there's some figures that have come out in these papers, and it has been publicised in the budget as well, that KiwiRail has cost taxpayers in the 7 years since it was nationalised in 2008 some $13.2 billion. That's a lot of money.
It is.
Not all of it is cash, but well over $3 billion has been in cash, and it's costing around about $1 billion a year to run. So there's a lot of money going out, and it's going into the rail network, a whole lot of things. But the fact is that KiwiRail is worth, as a business, nothing. It cannot really cover its costs. It cannot generate enough more freight to cover those costs and make a profit, and that's the core problem. And so at the moment they're in halfway through a 10-year program to turn this around, and the Treasurer is saying, well, we haven't got very far so far. Is it worth pressing on? The government's made the decision that, yes, we'll press on at a cost of between $100 and $200 million a year, depending on what you're looking at.
So what is the nature of KiwiRail's business and what's affecting it?
Well, the key thing that the Treasury looked at, and it came up with three different options. One is just to keep it going, hope to make it more efficient, get a little bit more rail, maybe chop off a little bit here and there. That's the status quo, which is costing up to $200 million a year. The second option was to just concentrate on a triangle, that's Auckland, Hamilton and Tauranga, where most of the freight is carried and is obviously the short routes and highly profitable. But the problem with KiwiRail's network is that a lot of freight goes throughout various stages of the network. In other words, it goes from Auckland down to Christchurch. and you've got a lot of costs involved in that. And so if you're going to make Kiwi Rail profitable, you either have to close the entire network and just forget about it and wipe out all your losses, or just maintain that core triangle in the northern half of the North Island.
So what alternatives does the government have to Kiwi Rail?
Well, the Treasury consulted with the Ministry of Transport, and they've been looking at this sort of thing for quite a while. In fact, there's some pretty interesting figures in these papers about what would happen if all the freight was moved onto rail. And the Treasury believes that the social cost of maintaining the existing networks around about between $55 and $170 million a year. But by contrast, the Ministry of Transport says that the environmental and safety benefits from rail are just $10 million and $20 million a year. In other words, there's no real benefits of keeping the rail system going on those bases, and a lot of the public think it's all about safety on the roads and environmental factors, reducing carbon emissions, that sort of thing. But 10 million and 20 million is very small. The ministry also reveals that the cost of transferring all that rail freight to the roads would generate more than sufficient user charges to build up capacity on the motorways, and as well as keep the traffic safety, and that seems to be the main concern. So what you'd have in fact is this billions of dollars that have been wasted on Kiwi Rail could have gone into building a much bigger and motorway network, or put it this way, it'll be built sooner rather than later.
So what would happen if the network was eventually closed? Well,
I was just pondering a few of these things myself, and I just sort of thought, well, what would New Zealand look like without the rail freight network? What would it look like if the Cook Strait ferries were replaced by much cheaper ships where it's just drive-on ferries? The rail-compatible ferries are actually very expensive to run, and you've got these trains running all the way down, going on a ship and then continuing on down. If you converted all to trucks, it'd be a lot cheaper on Cook Strait. That freight, if it's urgent freight or pharmaceuticals, this sort of thing, there's trucking companies already doing that. The other alternative is, and people poo-poo this sort of idea, but there's actually quite a profitable and efficient privately owned coastal shipping network, and that could be used. And of course you could convert some of the rail lines into cycleways. That's quite profitable if you take the lines up. But you could also convert much of the rail network in some places to road-compatible vehicles. In other words, you could keep the rail lines there, but maybe you add things for trucks, that kind of thing. And these are the kind of ideas I was coming up with anyway.
Finally and briefly, what happens to commuter rail in Auckland and Wellington?
Well, yes. Well, they're not going to be affected by this Treasury debate over the future of the freight system. In fact, they don't say very much about them at all. But what would happen is that the ones in Auckland and Wellington, and perhaps if Christchurch gets one, you'd actually have it run just discreetly. That is, it'd be an independent unit run by whoever's running the transport in those two parts of the country. And in Auckland, of course, we've got big problems with the rail because there's this mix of freight and commuter traffic. It's all actually run from Wellington, and that seems to be a pretty strange way to run a rail system when you're so far away from where it is. But that's the reality of how the network operates, and if the government's decided to keep that network going, it's got to tell the people, the taxpayers, that the cost of this network is quite high indeed.
Thanks very much for your editor's insight today, Neville.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free, and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
Now to housing and the Treasury. Treasury warned the government against selling off surplus Crown land for Auckland housing. The bundle of documents released after the budget show only 100 hectares of Crown land zoned for residential housing could be identified for sale, not the 500 hectares Housing Minister Nick Smith promised. Based on the Treasury warnings, the Cabinet approved $52 million for the project rather than the $120 million Dr. Smith sought. The Treasury documents have given Labor opposition MPs fuel for claiming the government's budget centrepiece policy of selling surplus Crown land was a disaster from the start. Labor's housing spokesperson Phil Twyford has come out on attack, saying the plan was so rushed it wasn't even put forward until after the budget moratorium began, meaning Housing Minister Nick Smith risked not having it included in the May budget. One of the main concerns of Treasury was it couldn't assess how much the land would cost to transfer from different departments or release from first right of refusal provisions. According to Mr Twyford, Nick Smith was warned that much of this land was subject to these treaty provisions, yet bizarrely he still picked a fight with Auckland iwi over it. The Treasury advice says, although we support the overall policy direction, our understanding is that there is still significant uncertainty around how much new funding will be required to progress these developments, as due diligence on the land parcels is yet to be completed. There is a risk that the contingency will be underspent, as a significant portion of the vacant land is likely to be held by departments, and the transfer or sale within the Crown is fiscally neutral and will not require new funding, and some of the sites identified are currently going through a Public Works Act offerback process and may not be available for development. It goes on. If Minister Smith would like to announce an initiative at budget, there are alternative options which do not involve committing funding beforehand. A capital contingency can be established at a later date when there is more certainty around what land can be developed, who owns the land, and how much it will cost. The Treasury paper advises, therefore, we propose that budget ministers agree to defer the funding decision associated with progressing developments on vacant Crown land in Auckland. Let's talk crowdfunding. Another equity crowdfunding platform is gearing up to offer young companies to the public with a focus on the science and engineering sectors. My Angel Investment received a license from the FMA in March, but has been biding its time before presenting a campaign to launch with a quality offer, according to co-founder Marcus Shipton, who has a scientific and utilities background. The first company to launch, a technology startup, will go live in about 3 to 4 weeks, he says. My Angel Investment was co-founded by Sydney-based Mark Malcolm, who has an engineering background with venture capital experience. The two other directors are New Zealand Council for Infrastructure Development Chairman John Ray and Southern Cross Venture Partners Investment Director Mark Bonner. Mr Shipton says to differentiate itself from the 5 other licensed equity crowdfunding platforms and draw on its directors' strengths, My Angel Investment will concentrate on science and engineering companies. Mr Shipton says the founders decided to take the plunge into equity crowdfunding, which became legal in New Zealand last August, to help growing companies access capital and give investors exposure to an asset class that had previously been relatively restricted. He says we see it as an exciting new opportunity for everyone involved. When you look around, you can see how many small startups have got off the ground as a result of funding. To be able to go out and seek money from the public is good for everyone involved and for New Zealand Inc. There are now 6 licensed platforms: Pledge Me, Snowball Effect, Equitize, Crowdcube and Liftoff, which also has not yet run a campaign. The marketplace is starting to congest, although the bigger platforms have told NBR in the past they welcome the competition. Liftoff director Bruce Shepherd says the marketplace is heating up, but he trusts the public to decide which platform is best. He says it's getting crowded, but the public will have to decide which ones to have loyalty to and which ones to stay away from. It won't take long. Go for the ones that look as if they're producing stuff with reasonable value. The FMA will not disclose how many licence applications it's currently assessing, nor how many in total it had received and turned down since crowdfunding legislation was enacted last August.
I'm John Stewart. It's Friday the 10th. The Independent Commissioners deliberating over Sky City's application for resource consent for its controversial convention centre in central Auckland have ruled it doesn't need to be publicly notified. Reporter Nick Grant has been following that story. Nick, why their decision that the public don't need to be notified?
The Commissioners apparently decided that the environmental impact of the convention centre project would be minimal, and as such, they have ruled that there isn't a need to notify it. Opinions on this will differ markedly. Obviously, the Green Party has been quick off the mark to put out a release bemoaning the lack of public consultation on it, and interestingly enough, Auckland Council appointed the independent commissioners and did make a submission suggesting that the project should be notified. However, the commissioners thought otherwise. Possibly the council made that recommendation because it was mindful of the political firestorm that occurred when it decided late last year that 2 extensions of wharves at ports of Auckland didn't need to be notified. That was a decision that had been was overturned on appeal at the High Court. And it does strike me that there's a good chance that that some group or groups will appeal this decision too.
Yeah. So then this becomes rolled up into the political controversy over the proposed convention centre, doesn't it?
Yeah, the convention centre has been dogged by controversy from the get-go. First, anti-gambling proponents were upset about the fact that Sky City got the deal to build the convention centre. Prior to that, there were questions about the way in which the tender process for building the centre was run, and the Auditor General came out with a report that suggested that the processes were rather lax,
right,
to say the least. And then there was obviously the controversy about having the government having sold the idea of the Sky City Convention Centre to the public on the basis that there would be no public funding going into it. Earlier this year, it became an open question as to actually whether or not the public purse would be raided. In the end, Sky City backed down from its request for public assistance in building it. So the cavalcade of controversy continues.
Indeed. Thanks for that, Nick.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
I'm John Stewart. It's Friday the 10th, and I'm joined by our economics and political editor in Wellington, Rob Hosking, who is having a look at the week that was. Now, Rob, I think at top of your list is the post-budget document bump, as you call it.
Yeah, this certainly gets a lot of politicos very, very excited. It's open government of a kind, I suppose. What happens usually around 4 to 6 weeks after the budget is delivered, the Treasury releases all the documents that it thinks, anyway, are relevant to the budget process out, instead of the old days where these things were, if you go back long enough, these things were regarded as a state secret, and even 10 years ago they were you had to. People like me had to rush in Official Information Act requests, and they now do what they call proactive releases, so they just slap them all on a website and you can go and have a look.
Right.
Well, when I say all, it's not all, and that's one of the big sort of things you've got to be a bit sceptical about this process, because quite a bit's redacted. And the other thing is because, of course, these things now are, it is known that they will go public eventually. They are written with that in mind. So, there's that old scientific principle, I think Heisenberg's, as soon as you watch something, it changes the nature of the thing being watched.
Right.
Well, that certainly applies to government.
Yeah, it also might have a little to do with backside covering.
Oh, there's quite a bit of, cardboard being stuffed down the trousers. It's very much like that. And a lot of this stuff has been about, in the last 24 hours since they were released, has been around proposals for tax changes. We know, of course, that they were one of the more significant parts of the budget. They were announced actually a little bit ahead of the budget, about 5 days beforehand, around what they call the Bright Line test for Auckland housing. For housing generally, taxing people who trade 2 years within 2 years as being basically buying and selling for capital gain. And the other thing is the register, of course, for offshore buyers. It turns out that Treasury had a couple of other wild and woolly proposals, which they floated before ministers, and the big one being basically an Auckland property investor tax. Now, there was a couple of pointed parts in this documentation, because the Treasury was told, listen, anything you come up with, you have to focus on investor housing, leave owner-occupied housing out of this. So they put up a number of options, and the Bright Line test, which did happen, being one of them. But the other one was this levy for Auckland property investors, basically on the capital value of their property. and 1% a year, or the gain on that property. And that would have gone to the Auckland Council. And the Auckland Council would probably have loved that money coming in, thank you very much.
Yeah.
But, the government wasn't quite so keen on handing over that sort of thing to the Auckland Council, and nor was it particularly keen on a levy in this area. And the Treasury officials made the point that, look, the actual surge in Auckland property values is not... There isn't evidence to suggest it's being driven by investor housing, or mostly driven by investor housing. You know, most of the buying and selling is still owner-occupied housing.
Right.
And so, really, if you're going to apply some sort of levy to the Auckland market, you've really got to collar the lot.
Yeah.
And, is the government going to put a specific levy on home buyers in Auckland? I don't think so.
No. Now, Rob, also the Kiwi Rail was in the news this week. In what way?
This was part of also part of the mix of considerations for the budget. Treasury suggested that maybe this is becoming such a loss that the government should just eventually get rid of it, let the whole thing run down instead of putting in. I think the government has put in. Let me think about this. It was bought for. I think it was bought for 600 million or something like a bit over 600 million. The value of it halved within months of it being bought. It was bought for much more than it was worth. And that was in early 2008. That was before the government changed. And the government changed, and the current government's pumped in at least $2 billion into it, and looks like having to keep doing so. So the Treasury is basically saying, is this really a particularly good use of this money? And it's the argument has really raged on this one because both the main opposition parties take the ownership of the railway as almost an article of faith. The question really is it's not so much about how much money. It is a lot about the money you're pumping into it, but it's about that very important economic concept of opportunity cost, and can you use that $2 billion you're pumping into it more productively elsewhere? And really, that's not a bad question to be raising about any area of government spending. And that's effectively what they were doing. On the other Kiwi, somebody joked the Kiwis, the Treasury got into Kiwis because they also suggested in one paper that to say the Kiwi program is not in line with government priorities. The Kiwi bird we're talking about, I think one or two ministers anyway probably choked at that one, and certainly everyone else has. That's a real Treasury policy nerd question.
Right, yes it is. Yeah. Now also, Rob, we had a business survey out this week.
Yeah, this stuff around where the economy is going, and we've got more on this in print today. This is the NZIER Quarterly Survey of Business Opinion, and it's probably the country's leading economic indicator. It serves about 2,000 businesses, or leading sort of forward indicator. It caused a lot of fuss because the headline figure has dropped considerably. Firms are asked all sorts of things, and one of them is, what do you think of the general business situation, and positive or negative, and so it's a sort of index, and it's dropped back from positive 20 to +7. When it goes negative, of course, it means they think things are contracting. But if you look at what their expectations for their own business activity is, it's nowhere near as bad as that, and it has come off certainly. But we're looking at a drop in output or growth of probably between, if you're being conservative, between 2 and 2.5% growth in GDP from what has been 3 to sort of 3.3, 3.5%.
Right.
And that's a drop from what we've had, but it's still a long way from recession.
So just to hark yet again to Greece and China this week, has that had much impact on government thinking?
They're watching things very closely, obviously, and Greece. I mean, our trade with Greece is fairly minimal.
Yeah.
The Chinese thing is a lot more significant potentially. But again, this is the Chinese share market. This is not a perfect analogy, but there are some small similarities. The Chinese are kind of learning how to, invest in shares and all the rest of it.
Yeah.
And they're going through, on obviously, a scale that's 1,000 times as large. But the sort of process New Zealand went through in the 1980s, when, we'd had share market investing before then, but it was fairly, minimal. And
workplace share buying clubs and that sort of thing were happening, weren't they? So
yes,
maybe we could see China heading that way.
As well as scale, the Chinese culture is very different.
Mm.
But we did learn in 1987 that what went up with the sort of rate that happened from 1984 can also come down, and that is something that the Chinese share market is experiencing at the moment. And there are a lot of relatively poor people, you would think, who are investing in shares. The thing about what's happening there is, just to stick with the comparison with New Zealand in the 80s, and I wouldn't want to stretch this analogy too far.
No.
But at least, the economic fundamentals underlying most of these companies that they're investing in China are a heck of a lot more sound than some of the ones that were share market darlings here in the 80s. So, this is a bounce back to some degree from what's been quite unrealistic expansion since particularly earlier this year. Things went berserk.
Okay, we might need to wrap it up there. But thanks very much for your view of the week that was, Rob.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
In NBR Print today, New Zealand company Forex Trend has been accused by Ukrainian authorities of involvement in an embezzlement scam aimed at financing pro-Russian separatists. Early-stage investing is enjoying a surge in popularity in New Zealand with record levels of angel investment, growing venture capitalist numbers and the emergence of equity crowdfunders. But as Calendar Smiley reports, those involved at the coalface warn there are great risks involved and a high likelihood of investment losses. Jenny Ruth reports the future of how the non-bank financial services industry operates hangs on the outcome of a Supreme Court appeal, with one person saying it's fair to say the whole industry's in limbo. Rob Hosking writes, more interest rate cuts are on the way as the economy drops a gear, but calls for a spend-up are misplaced. Auckland's Queen Street retail rents are pushing the $4,000 barrier as retailers battle for limited space at the harbour end of the city's golden shopping strip. NBR's special report covers business insurance, and Jason Walls reports if the agriculture sector does not pull up its productivity socks, the competitive advantage New Zealand enjoys will be lost as developing countries become more agriculturally productive. All this and more in today's National Business Review, out now. To Treasury and Auckland Housing, EY Executive Director David Snell says Treasury papers released yesterday on Auckland housing market options show a worrying air of panic. Mr. Snell, who worked for the Treasury for 14 years before joining the accounting firm in 2014, says the papers indicate the organisation wasn't given sufficient time to look at various proposals and contain unusually blunt language from the Treasury to a Minister of Finance. He says normally you try to be as tactful as you can in putting it across while still be full and frank. But he says comments in the papers such as, because of the very short time frame, this is a longer and less considered report than we would normally provide, are very unusual. Mr. Snell says the Cabinet didn't agree on requiring those buying and selling residential property to supply an IRD number until May 18, the day after the Revenue Minister, Todd McClay, had announced the measure. He says, I think that's evidence that the whole process was desperately rushed. Rushing through policy changes like this means that you don't necessarily get to think through all of the issues. For example, Mr. Snell says in the paper on the proposed levy on investors in Auckland housing, there was no consideration given as to why investors are the problem as opposed to owner-occupiers. He asks, why would you have the emphasis on demand when a lot of previous government commentary has been on supply? Implementing such a proposal would have required the cooperation of Auckland Council, but there's no evidence that Auckland Council was ever consulted. He says the paper proposed the measure as a temporary one with the proceeds going to the council, but contained no consideration of how it would be lifted. Mr. Snell says the council would be likely to find uses for the money very quickly and build it into its baseline costs. Neither were boundary issues considered, nor the potentially radical short-term impact on the housing market such as tax could have if investors were suddenly required to pay thousands of dollars more. Mr Snell says, the papers, in my view, didn't explore these issues adequately. I suspect because the Treasury wasn't given enough time to think it through. He notes the papers contained a lot of redacted material. He said there appears to be another option we're not being told about. The investment levy proposal was later dropped, with the government instead opting to impose capital gains tax on those selling residential property within 2 years of purchase, unless the property was owner-occupied, as well as the IRD number requirements. To the new tenancy laws, New Zealand Property Investors Federation Executive Officer Andrew King says new government measures targeting private landlords might not achieve much. Landlords will have to retrofit ceiling and underfloor insulation and provide their latest 10-year photoelectric fire alarms over 4 years under rules strengthening the Residential Tenancies Act. The new law also requires landlords to tell tenants the level of ceiling, underfloor and wall insulation. The NBR will have the power to investigate and prosecute landlords for breaching tenancy laws, and there are protections for tenants taking complaints to the Tenancy Tribunal. Building and Housing Minister Nick Smith says the insulation refitting is expected to cost $600 million, the benefits of $2.10 for each dollar of this cost. The smoke alarms are expected to cost $7 million. However, Mr King says nobody really knows how many rental houses are insulated and don't have fire alarms, and he suspects it's far fewer than the government's predictions. He says the government's assertions that 180,000 rental houses need insulation and 120,000 homes without fire alarms appear to be overstated. The 100,000 rentals the government believes will be impractical to retrofit with insulation because of limited space under floor or inaccessibly raked ceilings represents 35.7% of the national rental housing stock. Mr King says the insulation figure is based on landlords who used the warm-up program. He said many used it initially, but it proved to be more expensive than carrying out the insulation work themselves. Only 7% of the population provides rental housing. Mr King says the government has no idea about the number of rental houses needing insulation at a cost of about $3,000 to $3,500. He says despite numerous recent news reports of tenants living in damp and mouldy houses, these will be minimal across the country's rental housing stock. Mr King says this is borne out of figures by MB's advice line for tenants that says only 7% of the 100,000 calls a year are about property maintenance. A recent insulation survey of the Property Investors Federation's 6,000 members who hold 25,000 rental homes showed 92% of properties were insulated. However, 85 to 90% of rental property owners do not belong to the Federation. Mr King says many landlords own 1 or 2 rental properties, don't regard it as a business, and don't join the Federation or property investors associations. He says there is no doubt rental houses are generally not in as good a condition as owner-occupier houses, but these homes are also more expensive. It's really a case of getting what you pay for in the rental market. Mr King admits there are improvements needed as landlords are providing an essential service and need to keep that at the forefront of their business model. Most provide clean, decent, comfortable housing, and the tenant-landlord relationship works most of the time, he says. However, he warns there will be problems with the tightening of the regulatory rules under the new law. Mr King says as a tenant can ask for any property-related problem to be fixed, even if they've caused it, and a 14-day notice can now be issued to the landlord if the request is ignored. He says if the notice is also snubbed, they can go to the Tenancy Tribunal and claim exemplary damages of up to $3,000, which goes in their back pocket. He says most tenants know the rules and 50% of all tenants' applications to the tribunal are for exemplary damage, whereas only 1% of landlords apply for the $1,000 in exemplary damages they can be awarded when tenants skip without paying the rent. Mr King says the biggest problem for landlords is not the condition and maintenance of their properties, but tenants not paying their rent. Of the 45,000 cases that go before the tribunal every year, 85 to 90% are brought by landlords, and of those, 80% are for rent arrears. There will now be a 10-day process allowing a landlord to re-tenant a property when it's abandoned, instead of the 6-week procedure leaving a house empty and owners out of pocket.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
In court news, former wine boss and advertising executive Peter Scutts has been sentenced to 8 months home detention for taking kickbacks. Justice Mary Peters delivered her sentencing in the High Court at Auckland this morning. Scutts, a former CEO of the New Zealand Wine Company, was found guilty and convicted of 17 serious fraud office charges, in the High Court in May. The charges included one for receiving a secret reward under the Secret Commissions Act, while 16 others related to the dishonest use of a document under the Crimes Act. The SFO said Scutts, while working for NZWC, received payments from Australian Wholesaler Liquor Marketing Group, or LMG, based on the volume of wine sold. The Crown had alleged he received $1 per case of wine sold when NZWC supplied about 60,000 cases of wine to LMG. Each crime carried a maximum sentence of 7 years imprisonment, and Crown lawyers recommended 2.5 years in prison. Corrections had submitted Scutts was at risk of reoffending and recommended home detention. Justice Peters ruled out community service early on as not sufficiently strong enough and noted home detention is not a light option, as Mr Scutts and his family will find out. The judge first considered an 18-month prison sentence but made reductions for previous good character, as he has no previous convictions and good character references. She imposed a sentence to deter him and others from carrying out offences of the same nature. She told Scutts as he stood in the dock, "It will be difficult for you to find work which requires trust again. This sort of offending doesn't happen very often, and that might be it doesn't occur very often, or might be because it's hard to detect." In her written judgment in May, Justice Peters said she was satisfied Scutts lied in his interview with the SFO when he denied handwriting on particular invoices was his. He told the SFO his son Oliver had prepared particular invoices, not him. The judge also said the evidence of Liquor Marketing Group's Douglas Finlay was implausible. Scutts is well known in the advertising industry for his time managing Young and Rubicam, and in the rugby world as former chief executive of the Blues Super Rugby franchise. He was the chief executive of the New Zealand Wine Company from July 2011 until the company merged with Foley Family Wines in September 2012. Foley Family Wines made a complaint to the SFO in 2013. SFO Director Julie Reid has issued a statement on the case saying protecting New Zealand's reputation as a safe place to invest and do business is why the SFO targets both public and private sector corruption, even at modest levels. Businesses are also entitled to expect that their employees will act in the best interest of their employers. Cases such as this one reinforce that message. To Greece, the Greek government has met its creditors' final deadline with an 11th-hour bailout proposal submitted just hours ago. A spokesman for Eurozone President Jeroen Dijsselbloem tweeted the proposal has been received. Greek Prime Minister Alexis Tsipras tabled the reform plans, which include tax hikes, including extra taxes on restaurants and shipping companies, a timetable for privatisation and pension reforms in a bid to appease creditors' demands. In return, Mr Tsipras has requested a new €53.5 billion bailout package, which would cover his country's loan obligations until the end of June 2018. Mr Tsipras spent the day with his cabinet drafting the bailout package reform proposal. Whether or not the new proposal is accepted will be determined on Sunday at an emergency summit of Eurozone leaders. This follows European Council President Donald Tusk's indication the Council will make an effort to address Greece's key request for debt relief earlier in the day. Mr Tusk says the realistic proposal from Greece will have to be matched by an equally realistic proposal on debt sustainability from the creditors. Only then will we have a win-win situation. The new proposal will be voted on by Greece's Parliament on Friday or Saturday New Zealand time. Earlier this week, Mr Tusk said this was now the most critical moment in the history of the Eurozone. The new reforms have raised hope Greece will be able to stay in the Eurozone after the Greek people overwhelmingly voted no to bailout conditions last Sunday and the country defaulted on its $1.6 billion IMF debt repayment the week prior. Without a fresh injection of emergency funds, the embattled nation is poised to default on its $4.2 billion payments to the European Central Bank on July 20.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
To the wool markets, New Zealand wool prices eased in the first sale of the new 2015-16 season as demand weakened. According to Agri-HQ, the price for clean 35-micron wool, a benchmark for crossbred wool used for carpets and accounting for the majority of New Zealand's production, declined to $5.75 per kilogram at yesterday's North Island auction from $5.80 at the last auction. The price for lamb wool was unchanged at $7.20 a kilogram. Wool prices softened at the latest auction, even as a decline in the New Zealand dollar made it more competitive for overseas buyers in a typical slower period for the market. Agri-HQ analyst Emma Dent said there is currently the typical seasonal slowdown occurring due to well-stocked supply in China, which is resulting in reduced new orders for wool temporarily. Some 6,801 bales were offered at yesterday's auction with a 92% clearance rate. The next auction, scheduled for July 16 in the South Island, will offer 7,800 bales. The value of wool exports increased 11% to $793 million in the year through May, compared with the year earlier period, making it the country's 13th most valuable commodity export, according to the latest data from Stats New Zealand. For the month of May, clean wool export volumes declined from April, but were ahead of year earlier levels. Volumes to China, the country's largest market, were down 12% in the month, but were 6% ahead of a year earlier levels. Let's talk flexibility. A new survey has found around two-thirds of workers would consider leaving their current job if offered a comparable one with greater flexibility. The study, undertaken by recruitment firm OCG and diversity consultancy Divertis, surveyed 1,300 New Zealand workers across 20 industry sectors on changes to the flexibility provisions in employment law introduced last year. The Employment Relations Act amendment gave workers the legal right to ask for flexibility in work practices, but there is low awareness of the change among employers. Divertis Chief Executive Carol Brown said a perception persists that managers can use their discretion when it comes to flexible work, ring-fencing jobs, and people they want to offer those arrangements to, even though the law changes mean there have to be solid grounds for refusal. The survey found only 28% of respondents had formal flexible working arrangements, and more than half weren't aware of their rights. A further 28% who currently don't have flexible work plan to apply for it within the next year. Women remain the predominant users, mainly so they could care for family members. The survey found workers of both genders aged in the 31 to 45-year age group were by far the largest users of flexible work, which Ms. Brown said is an issue for companies, as this includes the middle management group who will eventually become leaders in the organisation. When asked about the key benefits to them, most respondents cited work-life balance and improved physical and mental well-being. Gen X respondents were more focused on caring responsibilities, while millennials wanted to be able to pursue personal interests. The main barrier stopping workers asking for flexible work, particularly millennials, is fear of negative career consequences. They're concerned it will be career limiting due to a widespread culture of presenteeism, needing being seen at work rather than being judged on output. They're also worried about excessive workload if reducing their hours. The two leading sectors for flexible work were financial services, mainly led by the banks, and government. Both sectors are also those with the highest number of female employees. The outlier was the IT sector, which, despite being 80% male-dominated, appears to be leading the way regarding flexible work. Silicon Valley-based talent expert and futurist Kevin Wheeler said there is a global trend towards workforce deregulation and flexibility, with workers wanting more choice over when and where they work. They're not necessarily looking to work fewer hours because they want to maintain income. He said the IT sector had pioneered a new way of working that doesn't require standard hours in the office, starting with stay-at-home Fridays that have morphed into don't come into the office unless you need to. He said new technology apps allow colleagues to communicate in this viral world when they need to. Mr. Wheeler said older, more established companies are still mostly resistant to making this move, compared to startups, and older workers are more resistant. Let's talk advertising. In the latest effort to raise awareness about the new alcohol limits, the New Zealand Transport Agency has created a deadpan cartoon ad. The ad features two men and an anthropomorphic horse in a bar exchanging knock-knock jokes about when to stop drinking. The campaign, which cost $108,000 and was executed by Clemenger BBDO, will run in cinemas, on social media, and have poster versions in bars. It's targeted towards those in their 30s and 40s and will finish at the end of August and then rescheduled. The campaign is predominantly metropolitan, so it will present in Auckland, Hamilton, Wellington, Christchurch and Dunedin. University of Auckland marketing professor Bodo Lang says despite having the prerequisites of a funny ad, he doesn't believe it will persuade people to reconsider their self-imposed alcohol limits. He says because of the nature of the ad, it's likely to polarise the audience. Some people will really like it, while others simply won't get it. Dr. Lang says NZTA is obviously trying to get those jokes into Kiwi vernacular, similar to what Ghost Chips did. But he says the nature of the humour is more likely to appeal to 20 and 30-year-olds. Asked if he thinks it's an expensive ad, Dr. Lang says it appears to be on first glance. He says, however, the best way to think about this is not as a cost, but as an investment into changing consumer behaviour. Whether the investment is worth the cost is dependent on the effectiveness of the ad, and that, of course, remains to be seen. And, of course, if you'd like to see the ad, nbr.co.nz.
NBR Radio. With Hotel de Brett, your home away from home, but with better service. NBR Radio.
In media news, it appears Pebbles Hooper is no longer welcome on TV3's Paul Henry Show following controversy over a tweet she made last Saturday. Outrage over her social media outburst led Ms Hooper to first issue an apology and then close her Twitter account. On Tuesday, New Zealand Herald weekend editor Mariana Alexander announced Ms Hooper had resigned as co-editor of the Herald on Sunday's spy gossip pages, effective immediately, and will also no longer appear in the Weekend Herald's Canvas magazine, in which she has had a long-running advice column with her mother, fashion designer Denise Lestrange-Corbet. Another of Ms Hooper's regular media engagements has been as a panellist on the Paul Henry Show, which is broadcast on TV3 and Radio Live 6 to 9 weekday mornings. In response to a query about whether, in light of the negative reaction to her recent tweet, Ms Hooper will continue to be a regular panellist on the show, a MediaWorks spokeswoman provided NBR with the following statement. Pebbles Hooper is part of a large and varied group of New Zealanders who have given up their time to appear on the Paul Henry panel. She is not scheduled to appear on the show again. Today, the youth commentator slot Ms Hooper had previously filled on the Friday panel was taken by Richie Hardcore. Mr Hardcore is a man of many parts, Thai boxing champion, a facilitator for Auckland Council's Community Action Youth and Drugs program, and a radio host on 95 BFM. In market news, the Commerce Commission has indicated it expects to make a decision on whether Z Energy will be cleared to buy the rival Caltex petrol station chain by mid-December. Z said in a statement the regulator has advised it expects to make a final decision on December 18. The petrol station chain said the date is indicative only and it's still pushing for a November 30 transition date. It said this will enable Z to be well positioned in the event there is a decision earlier than the indicative. In its application to the regulator made public this month, Z said its planned $785 million purchase of rival Chevron New Zealand's Caltex branded network won't drive up prices at the pump because the target doesn't have retail price-setting power and the market will remain highly competitive. A Caltex fact sheet says it has 147 outlets in New Zealand, supplies fuel to the aviation and shipping industries, and is a partner in the AA Fuel Card loyalty scheme. Z Energy is a shareholder in the rival Flybuy scheme, and its website says it has more than 200 outlets. Z shares were unchanged at $5.89 and have climbed 27% this year. In market news, the Independent Commission is deliberating over Sky City's application for resource consent for its controversial International Convention Centre in central Auckland, have ruled it doesn't need to be publicly notified. That's in spite of a recommendation from Auckland Council, which appointed the commissioners, that it should be. According to the Council, the commissioners had considered the environmental effects of the application and concluded these were no more than minor, obviating the need for public notification. In a statement to NZX that welcomes the decision, Sky City Chief Executive Nigel Morrison says he expects a final resource consent decision to be made in the next few months. This would allow the casino company to enter into a binding building works contract by October and start construction by the end of the year. The company had previously estimated that a notified consent process could have delayed the project by 6 months, while the government fretted it could set back proceedings by up to 18 months. Shares in Sky City advanced 1.2% to $4.25, having gained 8.3% so far this year. The stock is recommended as a buy, according to the average rating of analysts polled by Reuters.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.